My name is Christian Megel. I'm the founder of VentureLane. We are Boston's leading startup hub for B2B tech startups. And today is our number 3 in the series of Fast Lane, which gives us a great opportunity to talk to the local great VC firms that we have here in Boston. And today is going to be really about how to build the best VC syndicate for your seed round. So, and our guest is David Beisel, who will share his experience and his great learnings from many. David, how many years of VC work have you done altogether?
I've been in venture for 15 years. I started in
15
2005.
years.
Yeah.
God, that is 3 lifetimes. It feels. And I find syndication is actually a really interesting topic. Not that we only going to talk about this today, but syndication is some of those things that you might not even think too much about once you get a syndicate together and what kind of an impact on effect it has. But later on, as in every good partnership, you have to live with it and, to get the most out of it. These are some of the topics that we're going to talk about today. And by the way, as we're still waiting for a couple more people to join, 1 or 2 more minutes before we start with the webinar. If you're interested in programming, VentureLane opened up during the pandemic, actually, our programming to all early stage and general tech startups and entrepreneurs and founders. If you're looking for inspiration or knowledge or, want to hear from experts, look at our website, theventurelane.com. Under the calendar, you'll see our program that our dear Ross Pelly, our general manager and program manager, actually puts together in a very nice and sophisticated way. And our mission is really to help young startups, founders, the Boston startup ecosystem with anything around early stage, which for us is somewhere from early on idea stage to about Series A. Okay, I would say let's get this started. Welcome, David Beisel from NextView Ventures. You're the co-founder and partner, and congratulations to your $100 million fund that you just put out yesterday. It was
we just announced yesterday. It's good news.
Just timely for this webinar. David, tell us a little bit about your background, where you're coming from, and just maybe a minute or so of and your specialty also in investing.
Yeah, so I'd say I've started with my own background. I'm entrepreneur first and kind of internet marketer. Think Web 1.0 era. I started an email marketing company, which we ended up selling to About.com, and I ended up working at About.com for a couple of years as VP of marketing there. So I really do consider myself kind of an internet marketer first and an entrepreneur. And the way that I'm able to kind of practice those things is being on the investing side. And so I've been on the investing side for about 15 years or so, as you mentioned before. Before I started NextView with 2 of my 3 partners, I was at Venrock for a couple of years as an investor there.
Awesome. So deep knowledge in what's going on in the early stage funding. Now, David, tell us a little bit. I find it always interesting to understand how NextView and your firm is set up in terms of how big is the fund, what is your thesis, whom are you investing in? I mean, your thesis, you're looking for everyday economy. Maybe you want to tell us a little bit about what that actually means. Stages, check sizes, just like a couple of checkpoints so that people know who's the right
orientation
for you. Mm-hmm.
So NextView Ventures, we're a seed stage venture capital firm. We have offices both here in Boston as well as in New York, but we invest throughout the country. We are investing out of our 4th fund, actually, which you mentioned, we announced yesterday. It's a $100 million fund. And, I'd say fundamentally, we take what we call a high conviction, hands-on approach to seed, meaning we have a bias towards either leading or co-leading rounds, helping catalyze rounds come together. And then we take a really active role with our company. So we'll typically take a board seat or an active board observer role. And we very much consider ourselves seed stage specialists. I mean, over the last decade here at NextView, we've invested in over 120 companies. And whether you're an e-commerce, consumer-facing e-commerce company or a B2B SaaS company, I think there are certain things that just rhyme over the next 6, 12, 18 months after you raise your seed round. And we really become a thought partner to figuring out what are the seed stage milestones which need to be accomplished during that time frame. And we really help, I think, prepare our founders then to subsequently raise a successful Series A. Seed means a lot of different things these days. We can get into that as a discussion, but we'll invest across the broad range of seed. So within the last 18 months, I personally have written a $200K check into an accelerator company that we launched. I've written a $400K check into a $500K round that was more of a pre-seed round, and I've written a $2 million check into a $5 million round, which was also called a seed round, but obviously, profile of that round in the company was very different. For us, it's anything before a Series A we'll get involved with. And first thing, we work with the entrepreneurs to figure out what's the, do we want to be investors and they want to choose us? And then we figure out what's the right capital to invest at that time.
I was really impressed. Like you have in the 120 companies that you invested in, you have already 5 unicorns, which is pretty outstanding. But a lot of your very successful companies are actually companies that you invested in pre-revenue. That I found actually very interesting. That means that you need to have like a really good nose to kind of get to sense this. What's your criteria there?
Yeah, I mean, I think that's part of being a seed stage investor, right? I'd say probably about a third of our investments are completely pre-revenue. Probably a third are early product. Or actually, 2/3 are pre-revenue. A third are just like pre everything, and then a third there's an early product but not yet revenue, and then maybe a third are early revenue signs and some metrics, but not ready for a Series A. I mean, I think the criteria we think about when we make an evaluation of deciding to invest in a company, we look at 3 things, and 3 things in this order. It's team, and we can do a deep dive in any one of these. It's team first, then it's market. How big is the market, and how is it now, and how much do we perceive it to potentially become? And then the last one is product. And it's, I use the word products kind of broadly, like what's the current incarnation of the business based on the amount of time and capital which has gone into date. So to some degree, it's a way to measure, given the resources that the team has had today, what have they been able to accomplish, so that you can kind of extrapolate, going forward, how kind of capital efficient and ability are they going to be able to execute.
Nice. By the way, just for our audience, if you have questions, we'll do a bit of Q&A right now, probably for the first 20 minutes or so between David and I. But if you have an urgent question, just put it into the Q&A. We'll leave enough time at the end to also go back and forth on audience questions. So don't be shy and just put it into the Q&A right down here. David, we're talking about VC syndication. Let's take a step back here. Sometimes I feel that some people are a little bit confused about, should I go to a VC? Am I ready here or not? What do you think? What's a good fit for a company that says, I want to have institutional money, and I want to raise money from a VC firm? What do you think in comparison to friends and family or angel rounds?
Yeah, what I would say is you want to raise, or at least consider raising, institutional money if you want to get in the fast lane right away. I mean, so whether it's you raise from NextView or from any other venture firm, we're going to push you to go fast and go quickly and build an enduring firm, an enduring company that's going to just scale to either hopefully hundreds of millions of enterprise value, if not billions. And over that course of that time period, the founders are going to raise successive rounds of venture capital along the way. That is a certain path. That is not the right path for every business, and nor is it the right path for every founder. I mean, there's some founders that say, hey, I could raise $1 million and then get to a cash flow break even and never have to raise another dime. And I think that's just as viable path. That's not, that $1 million you don't want to raise from a venture capital firm, because they're going to want to push you to raise the next money, a round of capital after that. For us, if something's working, we want it to be working even better. So let's raise more capital successively.
What kind of qualities are you looking into in a founder and an idea here when you say this is right for us? I'm sure there's different aspects of everything, but I'm sure that you also have like a certain target, what you're looking out for, like a certain pattern that really comes over and over again, and maybe indicates possibly like a higher success rate than others.
Yeah, well, we hope for a higher success rate, right?
Yeah.
The word we use internally here at NextView is authentic. We look for authentic founders, and by that I mean founders who have had previous experience that either gives them a unique insight and/or a unique ability to execute in a better competitive way than other entrants into the market. And so,
like an unfair advantage.
Yes, we're looking for people that have an unfair advantage given the experience that they've had. And so for us, we care less about experience in terms of duration and years and career. We've backed everything from serial, entrepreneurs, and this is their third or fourth startup. We've now been in business for a decade, that we've had the luxury of now backing repeat NextView entrepreneurs. But we've backed a few entrepreneurs that are literally out of the proverbial college dorm room. And in those cases, their idea and what they were doing was authentic to who they were and their experience set. And so, that's the word that we end up using a lot in evaluating, like, does their authentic experience give them, an unfair advantage? And then, the other thing, which I meant we touched upon, but only briefly, and I'll put it in, I think I can put it in all the chat. Let's see if I can do this. We have a thematic approach here at NextView around what we call the everyday economy. So we invest in companies which are taking best-in-class technology and applying it to people's everyday lives. So about 60% of what we do is consumer-facing, and then probably about 40% of what we do is B2B2C, or enabling layer technologies, which help transform a consumer experience.
Okay, we had a question here from Chuck, whether you do education technology at all.
Yes, we'll do a tech in the context of, does this affect people's does it affect people's everyday lives? Yeah. We don't have I would say we don't have a dedicated kind of ed tech specialty or practice that's one that we kind of raised our hands and said that's where we're specific interest in. My partner, Rob, actually has spent the most, of our partnership, he's the one that spent the most amount of time in that space.
Yeah. And just from our friends here at Learn Launch, who are also here in Benchland, actually, I know that education technology, obviously in the pandemic, went a little bit through the roof with a couple of applications. So really, yes. Definitely a hot area. David, let's talk about syndicates. How would you describe a syndicate? What is a syndicate?
So a syndicate is a number of different venture firms which all come together and invest in the same round of financing for a startup. I think today, most typically these syndicates are coming together in the seed rounds, where you have one or two lead firms, which are either leading or co-leading seed rounds. And then you have a number of other smaller firms, which are writing, a couple $100K checks to, also participate in a round coming together. And then obviously, the syndicate of investors evolves over time, as the startups raise, successive rounds of capital, raise a Series A, a Series B. Most times, not always, but most times a new firm will lead the next round of financing. And, occasionally one or two new firms will also join those successive rounds. And so you end up as, a founder, have a set of investors that are from a number of different institutions that are all, investors in your company that, joined all along the way.
Yeah. What would you say, like from your own experience, like over the years, and you've built quite a few. We talked about it this before the webinar. You built a few syndicates as a leader, but also as a follower. Tell us a little bit from your perspective. You know, if I was a founder, like what do you see the biggest advantages of having a syndicate? And what are maybe the disadvantages? What are the things that I have to bear with? Possibly complexity and different things.
Yeah, no, that's a good question. So, first clarification, we at NextView have a bias towards either leading or co-leading rounds. That being said, we want to be investors in the best companies possible. So we have no ego as to who's leading. We just want to be investors in the best companies. So a syndicate, the more players that you have in a syndicate, they're obviously on the negative side can increase the complexity, but then on the positive side, you can bring together different attributes from different firms. And so what I think the overarching goal should be for founders, you want a well-rounded set of syndicate partners. You don't want a syndicate of well-rounded partners. So let me double click that. You don't want a bunch of well-rounded firms. You want to choose 1, 2, 3, 4 firms, however, in that seed round, which bring different things to the table, right? And so in many cases, you want to have it's beneficial to have a lead investor in that syndicate, so they can play that function of setting the price and being driving the round coming together and taking a board seat and representing the whole set of investors. But then you might also want to add another syndicate partner that's a domain expert, right? If you were putting together a consumer health company, it might be interesting to have a syndicate where you had, a healthcare specialized firm that was one syndicate partner, and say it was a consumer, digital health company. And then you might be interested in also having a consumer expert VC firm, because they're going to bring different perspectives to the table. They're going to have different networks that they can refer into, both for hiring and for customer development. And so, you want to be deliberate about picking different firms that can play a different role in your investor set.
How realistic is it that in the end you actually get to choose and pick what you want? I mean, obviously, if you've got a great company, great traction, and everybody wants you, and you've got 10 term sheets, probably easier. Some might be just happy to get 1 or 2 term sheets. And so how realistic is it that you actively can choose your syndicate, whereas the syndicate chooses you?
Yeah. So I think, I don't know why. It never made sense to me why funding starts with the letters FUN. Like, fundraising is hard, right? And I think often the syndicate chooses you, but at the end of the day, it is about finding a mutual fit. And even in the beginning of a fundraising process, when entrepreneurs are figuring out, okay, who should I approach? You're doing the choosing there, because you can decide who you're going to approach based on what their portfolio looks like, what their engagement model is with founders, what their reputation is with some of your peer founders. And so even if you only end up reserving, 1 term sheet at the end of a process, A, that can be success, and then B, you did choosing along the way about who you wanted to approach.
So I think this is a really interesting point. What you're saying is actually who I approach at the very beginning obviously has an impact on who might possibly come back. So yes, the choosing starts with who do I approach at the very beginning. At the end, it might still be that other people choose me, but at least the pool of companies will only be the pool that you ever approached, right?
Yes, that's right.
So there comes a little bit of thought into that. Yeah, okay, I like it.
It's maybe a cliche phrase, but I believe it, which is that, fundraising is about the search for believers. It's not about convincing the skeptics. Mm-hmm. And you want to find potential investors who are going to believe here, not just believe here. And so it's about fit. And so when doing the research up front, you want to find firms that have portfolios that rhyme with yours, and or have similar, whether it's the same kind of domain, or the same, if you're a marketplace company, invest in other marketplace companies, because they understand that kind of business model. And so finding the right investor, it does mean, choosing upfront who you want to approach. So I think that's a really good point.
I want to ask you, like, to get it right, obviously, there's many good reasons, if you get it right, that you have a lot of advantages. Tell us a little bit, maybe give us some experiences that you made where a syndicate actually did not work out, and what are the downsides if you don't get this right? What could happen?
Yeah, I mean, so I think there are times when different investors have different motivations about why they're investing in the company.
Can you give us an example?
Yeah, so I'll give an extreme example and then maybe a little bit less extreme. I think it can be a challenge to add strategic investors, especially very early on in a company's life cycle. Literally, by definition, a strategic investor is investing because they're doing it because of their strategy, right? They're not doing it for a financial gain necessarily. And so, their goals in what they want the company to do from a strategic standpoint, what kind of customers they have, can be in opposition to what is best for the company and best for the founders, and then best for other investors. So, I mean, I've been on a board where, not to get into too many specifics, but the strategic investor wanted to do something different. And part of the challenge wasn't just that their strategy was different than the startup, but that their strategy was secret, and they weren't telling the startup why they were making decisions the way they were. And so it became, somewhat dysfunctional because you had this strategic involved that wasn't aligned with, us, the existing investors, as well as, the founder and the management team and the rest of the shareholders.
Yeah, the one thing I find always I have been, as a founder, I've been in a situation where we had a strategic, or possibly a strategic partner that put money in there. And what you need to understand is sometimes the goal is actually for the VC possibly to make this the most valuable company for a strategic partner who actually thinks like, oh, I might take this company over, I want to work together. Their goal is not to make this $1 billion company, because so therefore to know the needs and know the why are people in that is probably super important to find out. Oliver here asked, for B2B2C companies, in your opinion, is it better to have a core corporate partner or not? He feels that he gets like a 50-50 answer of VCs saying, hey, you should have a core corporate partner, or you shouldn't. Do you agree?
I don't completely follow what you mean by having a core corporate partner. I mean, strategic channel sales partner, maybe.
It's probably like that. Yeah.
Yeah. I mean, I think it's my initial gut is probably not, especially at the earliest of stages. Again, I think at the earliest of stages, you as the company want to have the most direct relationship with customers as possible. And so that usually means going direct. And as well as if you're too tied into a corporate partner, again, there can be a misalignment of incentives as to what you're trying to accomplish and what they're trying to accomplish.
Yeah.
I think it can be a challenge. The earlier you are, I think the general rule is the earlier you are in the life of a company, the more challenging, a strong corporate partner, whether they're an investor or not, can be. And, as you become more mature and more established on your own, then, having those relationships can actually then be accretive or beneficial.
Yeah. David, let's talk a little bit about what is the sequence of events. Carlos was asking a question here. What is the sequence of events that to form a syndicate, from finding your lead, finding your follower possibly, but possibly even integrating a bunch of angels? How would you say, like, what's first, what's second?
Yeah, I think first things first is to try to find a lead investor. Try to find someone that is, and lead doesn't necessarily mean that they have to write the biggest check. That is often the case, but I don't think it's a requirement. It means they're an investor that's willing to say, be 100% committed. I want to invest in this company. I'm willing to write a term sheet and get in front of the parade to help catalyze this round come together. Not all firms are willing to do that, and some say they do, but they do it some of the time, but not all of the time. And so, and it's somewhat opaque as to who is really doing this often. But the first key is to find someone who's willing to lead the round. I think from there you are able to use that momentum to get from having a term sheet, and usually then is a dialogue between the founder and the lead investor as to, okay, how much, how big of a check does the lead investor want to write in relation to the how big the round is, and then what other players might help complement that lead investor, and that can be both other VC firms as well as other strategic angels.
Can I ask you just a quick technical question here? Does that mean like I'm really going out for the lead investor and don't care so much about all the followers and the smaller checks and the angels because I need to find that lead because the lead has such a big say? Or how do I spend my time?
I think you prioritize finding the lead, but if you have opportunities to meet with people along the way that are ability to write checks, and you think they could be helpful in the larger syndicate, you don't want to put them on pause. You don't want to put them on ice. You want to kind of keep them rolling, but you don't push them along at as fast of a pace, because pushing them on along a faster pace, they're eventually going to get to a point where they say, well, okay, well, what are the terms and what are the details? And if you can't answer them, that you want to be able to close them. You want to be able to close them, quickly when they reach that point, and at which point, when you have the structure and what the kind of details of the round are, it becomes much easier. And so I would prioritize, but not completely relegate the followers into kind of a second set of priority conversations.
There was also a question Carlos was asking, like, how are the deal terms affected by syndication? Well, it's probably, once you have a lead, these are the deal terms. There's probably not much wiggle room left once you decide on that, right?
That's usually the case, unless for some reason you're able to get another larger firm another large check that wants to come in, and for some reason they have a requirement that they need to kind of amend those terms. But most of the time it's established by that lead firm.
David, do you feel that there's like a minimum amount of fundraising that you need to even like have a syndicate? Does not make sense under this amount in like a seed stage or early stage?
So I think when you start raising, if you're raising less than, call it $500,000, maybe even a little bit more, you can take a different approach, which is, I call it the subscription approach, which is you as the founder can say, hey, I'm raising capital, it's either on a safe or a convertible note, and here's a valuation cap. And you go around and you tell people, here, these are the terms, and do you want in or out? And people and then usually this is just individual angels, they either subscribe or they don't subscribe. And I think that that's a different way of going about it. I think it's that methodology is not as effective if you're trying to raise a couple $1 million and you're trying to solicit institutional capital. When we don't have founders coming to us saying, okay, here are the terms for our round for $3 million. Do you want to write $1 million check? Are you in or out here? And these terms, that's not how the process works.
Got it. By the way, fill the Q&A channel with your questions. We're already answering a couple of them, but feel free to drop up a couple more questions. A question from Yoni was is there a difference? Do you see a difference? I think this is probably not you can generalize, but is there a difference in terms of how long it takes to structure a deal, depending on whether you have one lead and maybe a couple of extras, smaller angel checks, versus a syndication? Does a syndication slow things down, or maybe even speed things up?
Yeah, so the syndication to a number of VCs and or angels, it definitely slows things down, because what tends to end up happening is there's a lead investor. They say they want to write, say $1.5 million check out of a $3 million round. Then often that lead VC will say, oh, hey, here's somebody I invested with before, and bring some, parties to the table. And then usually the entrepreneurs have been talking with some other firms, and they bring some folks to the table. And, often what happens, and then there's a lot of excitement about, okay, well, and then it feeds on itself. Well, okay, everyone's investing in this round, and it becomes, potentially oversubscribed. And so in those cases, it's the entrepreneurs flips from trying to solicit, okay, I need more dollars, to, okay, how do I deal with who's in and for how much? And, there's just complexity to managing many different parties, and they're all coming together into, around at the same time. And they're all going to have some minor requirements about this or that. And, many of them, as the definitive docs are being drafted, will want to have comments on this or that. And, some might have, just for example, have, a preference. They want to be included as a major investor and getting that designation. And so, just the more parties you have at the table, there's more communication. And so at some point there's diminishing returns to having more parties involved.
Yeah. When do you think is that point? Here at Venture Lane, we had a bunch of companies that, started early on, rather than doing a dedicated campaign and reaching out to a bunch, but like do a little here, a little there. And that ended up like talking to some firms over weeks and month, and would stretch things out. When is the point that all above, when you have a bunch of interest, when do you say no to another party that wants to join? Or how do you make this efficient? Because obviously at that time you don't only want to raise funds and get these great partners on board, but you also have a company to manage.
Yeah, I think so. At the beginning, I think from the outset, you want to make your fundraising process your full-time job, and it's hard. It's hard to do that because you have so many other things going on.
And that's for the founder?
For the founder.
Okay.
And because if you make it your part-time job, it can drag out longer than you would want to. And I think you can end up putting in, or over the time, more time involved, because it gets drawn out over and over. I think the best way to run a fundraising process is to say, this is what my priority is, and I'm going to go out and I'm going to give myself, X amount of time to raise X amount of dollars, and be very kind of deliberate about it. Part of your question subsequently was like, after you raise some money, then, folks can continue to kind of trickle in. They hear, oh, I heard this is a good round, maybe can I be a part of it? I think that's just a matter of like, at some point, the 80-20 of like, this is just not worth my time for the incremental whatever dollars it is, because I could be just building more value with, turning my attention back to my startup. So I don't think there's a hard and fast rule as when you stop fundraising. I mean, I think at the end of the day, founders are always fundraising, and you should be always fundraising. We can talk about that, but like, you're always selling your company, your product, and that's to potential employees, to potential customers, and to potential fundraisers. And so if dollars show up and it's at a price that you think is appropriate, take it.
Okay. Can I ask you, like now, like let's say we've taken some money in. I always get this question. How do the one thing is the money, and it gets me the resources that I need to go to my next step. What are best practices that you've seen of founders really extracting great value and benefits from a connection to their institutional investor, be it as a syndicate or be it as a one VC here? What did you see? How are people clever about actually not just getting the money, but actually the smarts that comes with it?
Yeah, so there's a couple of things. I think one is about communication. Keep your investors up to date, and I don't think there's a preferred mode. I mean, and that depends on the style of the founder and the style of the investor, but figure out a way to keep up to date. That could be from, investor meetings to weekly or monthly or every 6-week emails, communication. And that means both what's good, what's happening, but then also being transparent of the bad. So you can develop that trust with your investor. And then it's about, I think, specific asks. I think you should not be hesitant to say, hey, I see you on LinkedIn, you're connected to this potential partner or this potential customer. Here's an email that you can forward to tee up that introduction. Like, be direct, be direct and ask. Institutional VCs, have a broad portfolio. They're not getting up every day thinking, how do I help just your company? They're trying to help all the companies in their portfolio. The good news is, as a founder, you get up every day thinking about how do I help my company, and you've got an investor that wants to help your company. So be direct and proactively ask them if you know ways that they can be helpful. Just be proactive and ask them.
No, I like that. Yeah, actually, communication, I guess, is the biggest one. Somebody cannot help you if they don't really know what your needs are, yes. Right? Going back to the Q&A board here and keep on coming, please. Chuck was asking, is there a typical runway that you're looking for? Like, if you're a founder, like, for what kind of runway are you raising? 18 to 24 months, is that the right?
Yeah, the 18 to 24 months, I think is the kind of typical rule of thumb. It's about, at the end of the day, it's about milestones, right? It's like, where along the path are you going to have not just generated incrementally better value, but there's a step function, right? Like, either you just released a major product, or you just got a milestone in terms of 5 new customers or 10 new customers. You're going to cross a threshold of 50K a month of revenue or 100K a month of revenue. Big salient milestones. Those are right after you hit a milestone is when you want to raise your next round of financing. And so it's trying to plan for, how do we raise enough money so we get to those key milestones? So then right after that, we can go out and raise that next capital. So that way you'll get a step up in valuation that you deserve.
Okay, love it. George was asking if there are scenarios where institutional investors actually agree to common stock for example, like a 10 million plus deal. Any idea around common stock versus preferred stock?
I rarely see it, but it does occasionally happen, I think, is the short answer. I mean, there's one other firm in town here in Boston that, promotes the fact they will take common stock. I'd say for the most part, if you're raising from institutional VCs, it's preferred stock, but I think it's fairly standard, especially among seed VCs. We end up here. I'll put a link into the
chat.
Into the chat. I don't know if the lawyers here would like, but that's all right.
Love your being hand-on. Good
yeah,
stuff.
Here we go. Where's the thing? We at NextView, we use the Series C documents. And so we have a template that's just 1 or 2 tweaks from the term sheet that's right here. We use that template. We have accounts that we use all the time that just uses these Series C documents, and we use it as the basis. And they're as plain vanilla as possible. And our philosophy is that the more that you tweak things earlier on gives later financiers the moral license to tweak things even further. So you just want to make it as simple and plain as possible at the beginning.
Yeah, you don't want to spend time talking about documents and little clauses rather than fundraising, I guess.
Yeah, and I'd say maybe about 30 or 40% of the time we're doing safe documents these days as well. Okay. It depends on what the nature of just the dynamics of the round in the company.
Carlos is asking, should founders be transparent with those other potential members of the syndicate that you're trying to find the lead first and you're okay waiting until then?
Sorry, I missed the.
So should you be transparent with like all the contestants that you're actually trying to find the lead first, and that you're once you have that, then you're talk about the follower.
I think for folks that are going to be followers and or it's very clear that they're going to be followers, I think you can be transparent and say, hey, like we're out looking for a lead. I think it's good to get their interest warm, but I wouldn't ask for the order, so to speak, until you have the until you have the definitive terms. because then they're not really committing. They can say it's a soft commit. Yeah, I'm in for 100K, but they don't really know what the terms are. So, what can you, they're not going to be able to completely confirm. Where I wouldn't be as transparent is when you're talking with a multiple potential leads. You don't want to tell the other potential leads who else is in the running, who else they're competing against, because either they may try to call up that other firm and find out, what their point of view is and use that in a competitive way, and or it kind of abdicates some of the power you have as a founder as to the scarcity of your round. And so it isn't until you're far along that you really have established a trust with your potential partner that looks like there's going to be a deal, there's going to be a handshake here, that you want to start then revealing who are some of the other parties that you've been speaking with along the way.
And by the way, that makes really a great guest here if they give you tips that are not in their own favor here. So obviously, I think institutional investors like to talk also in the background with people that they know and that they're syndicating with and so on. But yeah, it might be in the best interest of the founder actually to just keep this out of the communication until you actually made your decision.
Yeah.
Last quick question from Emily before we have to wrap up. Can you talk about the happy problem? I love it, a happy problem to be oversubscribed rounds. You mentioned taking the money if the price is good, but what do you do when you all of a sudden need to go back to your lead investor and say, hey, I think we talked about this, but now we're oversubscribed by a certain percentage. How do you deal with that?
Yeah, so I think in oversubscribed rounds, no one's going to be completely happy. That is just the nature. Everyone wants a little bit more. I think just from a philosophical standpoint, the way to think about it is to make more people mostly happy than getting more people kind of happy. So in other words, you'd rather have a fewer number of syndicate partners that got most of what they want than to a larger set of syndicate partners who really aren't that happy with what they got. And so you want your investors at the end of the day that are, when they're coming into a round, it's a subscribe round, oversubscribed round, that they're mostly happy. They mostly got what they want. And so I think that ends up meaning cutting some partners and just completely out, and but making the people that are going to be in ultimately mostly happy.
And probably not to forget, this is a partnership. This is not just like a transactional situation here.
That's right. You have to live with these people for the next.
You wanna create a win-win situation that's good for everybody. And of course, a VC has a business to run, and as much as you have. I think there's no point of seeing it just only one-sided. David, as we're approaching 12:45, how can people reach out to you? How can they get in touch with you if they have questions?
Yeah, let's see if I can get some more links we can throw out here. Got too many windows open. Find me on Twitter. That's the easiest place, and then. I'm on LinkedIn as well, and my email address is public. It's just david@nextviewventures.com.
Awesome. And then a very, very last question, if what is the best way to pitch you? I know that many people are not so happy to just send a random email or LinkedIn request here. What do you think best practice, what works best for you?
Best practice is to get some referral into us. I don't think you need that warm of a referral. I think just showing that you have the ability to execute to get some kind of referral in is reflective. That being said, within the last 2 years, I have made a new investment out of a completely cold email in those founders, and I got to know those founders pretty well, and we're gonna make some money there. But what I would say is that reach out email was clearly written just for me and our firm. It was not. I get lots and lots of inbound cold emails that are clearly just copy and pastes. This, the one I'm talking about specifically, where they reached out cold, talked about what they were doing, why it was a good fit for our firm based on our theme and the investments that I personally have been involved with. And so it made a lot of sense. And so I think, if you're going to go the cold route, that's you want to give a lot of thought to it.
Cool, good stuff. David, thank you so much for attending here. That was awesome, great insights. Love that you actually talked. We went through a bunch of things like how to do a syndicate. What are the advantages and disadvantages? I think it's about communicating with your investor once you've chosen them, but also play it fair. And really like how you raise and where does it make sense to actually bring a VC in or bring somebody like next to you in, or where not. So very insightful. Thanks for always thinking and have the founders in mind. And I'm sure, as reach out to David over LinkedIn or Twitter, and I'm sure he will be happy to answer your questions or find a referral to get and pitch David, who got a brand new $100 million fund, which is really exciting.
Yes, thanks a lot. I really enjoyed it. It was really fun.
Thanks, man. Have a good one.
Yeah, talk to you soon.